With markets treading water post Wednesday's robust ADP payroll report, what can we expect with Friday's big jobs number? Here to tell us what we should be watching is TheStreet's Scott Gamm. Scott, welcome back to the show.
Thank you.
So Wednesday we saw some robust numbers here, Scott, but equities rallied to only sell off after the Fed minutes. What can we expect heading here into Friday?
Well, yeah, the ADP report was much better than expected. 263,000 private sector jobs created. The estimates were 170. So we're looking the estimates for Friday's jobs report at 175. And yes, we could get a rally if it's a blowout jobs report. But the question is, does it get overshadowed by President Trump's meeting with China's President Xi Jinping? That's obviously something the markets are watching.
Right.
And do investors continue to worry about House Speaker Paul Ryan's comments that, hey, he needs more time for tax reform, and this is what the markets have been rallying on for the past 4 months, tax reform, tax reform, tax reform, and the last thing investors want to see is a delay on that front.
So Scott, do you think that we're going to see a shift here of investors looking more at the Fed's balance sheet over interest rates?
Absolutely, and that was illustrated in the minutes report, which were released on Wednesday, the minutes of the Fed's March meeting, where most participants said, look, we're going to potentially start unwinding the Fed's $4.5 trillion balance sheet this year. Many analysts that you and I speak to thought it was going to be in 2018. And what that means is basically right now the Fed is taking the bonds that mature and reinvesting those proceeds into new bonds, maintaining the size of its balance sheet. So essentially quantitative easing, even though it officially ended in 2014, it's alive and well. And the question now is, does the Fed taper those reinvestments or slowly wind them down altogether? If they do, that could raise and steepen the long end of the yield curve.
Yeah, you spoke with Jim Cramer earlier on the floor of the exchange, who said, well, maybe it's not so much of a bad thing, right?
Right, because if we get a steeper yield curve, especially on the long end, that's good for bank stocks. Of course, the banks get more money, they earn more money when we have higher interest rates. So the combination of the Fed unwinding its balance sheet plus 2 more interest rate hikes this year would be good for bank stocks. And also, if you have a flat yield curve, you have people start pounding the table that, hey, a recession is coming. So, who needs to deal with that?
All right, we'll see what tomorrow has in store. Scott Gamm, thanks so much for your thoughts.
Daniela, thank you.
And thanks for watching this edition of Kitco's Gold Report, preview to Friday's jobs number. We'll see you tomorrow.